years old. It's going to be interesting to see what happens in the next 15, 20 years when those people do pass away. What's going to happen with, I'm assuming that a large, aside from foreign buyers potentially, but I'm assuming these aren't people working, standard 9 to 5s. They're just paying off their mortgage in 5 years, right? To be mortgage free, you've either been paying it for many years, so kind of fitting into that baby boomer class, or someone who's buying it cash as a foreign investor potentially, or I guess it could be, a local investor, but I can't imagine that half of the homeowners in Toronto are just your average mom and pa working their 9 to 5, paying their mortgage off quickly.
You're listening to the Ottawa Real Estate Podcast with your hosts, Paul Stevenson, David Warren, and Greg Campbell. Let's see what's going on in the world of real estate today.
Good morning. Welcome to the Ottawa Real Estate Podcast, where we bring you the latest news and insights on the dynamic and ever-changing real estate market in Ottawa, Canada's capital city. Our show is designed to keep you informed and up to date on the trends, developments, and opportunities in the local real estate industry. Whether you're a seasoned real estate investor, a first-time homebuyer, or simply curious about the market, our expert guests and hosts are here to provide you with valuable insights, tips, and strategies that can help you make informed decisions about buying, selling, or investing in Ottawa's real estate market. So sit back, relax, and join us as we explore this fascinating world of Ottawa real estate.
Wow.
Yeah, that was
great intro. Great intro. Right off the cuff.
Yeah, just off the top of my head.
Off the top of your dome.
That was ChatGPT wrote that for us this morning, right before we came on. I thought it'd be hilarious. My name is Paul Stevenson. I'm here with David Warren. I forgot to mention that. Thanks, ChatGPT. Greg is in transit. He won't be joining us today, but how's the week going, David? How are you doing?
Good. I'm in Orlando right now with the family and did Disney yesterday, which was an interesting experience for any of those that have actually been to Disney. It is exhausting, frustrating.
Yeah. How were the lines?
Holy frig. It's outrageous. Like, period.
We even Walk me through Disney these days. When I went, I was a year old.
$30. So, okay, go ahead. Sorry, when it was a year old.
No, I was a year old. That's it. I just want to know what's changed.
So it's massive, but so they have. I mean, you get fleeced at every, in every capacity, in any way they can, upsell you on anything. But we paid an extra $30 for this ability to skip the line, which obviously is like great when the lineups are 60 to 2 hours long to get on a ride, which is horrible. But you can only book one ride, and then you can only book the next. And really, it's some rides you can't get until like you get there in the morning, and even on that skip the line thing, you can't even book them till like 8 p.m. It'll be like it'll be like 8 p.m. or something like that, and you can only book one at a time. Anyways, it was just absurd. Anyways, long day. We didn't even stay. There's like fireworks at like 8. We just cut it early and just got the heck out of there at like 5:30. We're like, we're done.
Yeah, well, at least your son is young enough to not even know what's happening. So I was like,
no. Oh yeah,
great. Let's go home. Perfect. That's awesome.
Oh yeah.
Was it? Is that Universal Studios or is that?
No, it's like it's Magic Kingdom. Magic Kingdom, and I don't know. There's all the. Anyways, yeah. Don't know if I'll ever be going back there again.
No, I've heard similar stories, but I've never ventured.
How was your weekend?
Weekend was good. Lots of hockey. Happy Family Day, everyone. Belated. We went to the Sens game on Friday against Chicago. That was pretty fun. It was the first time we'd gone as a family in a long time. Obviously, not cheap to go to a game these days. But it was fun. They lost in overtime, unfortunately, but boys are buzzing. They're playoff bound. We're going to beat the Leafs in the first round. So that's what I'm calling it now. Anyone watching? But outside of that, just yesterday, hung out with my brother and his family, and we had a game last night, which we lost, unfortunately. And here we are, Holiday Monday.
Getting right after.
More hockey this afternoon. So
and more mortgages.
Yeah, more mortgages. So switching gears, might as well actually talk about real estate while we're here. So Canadian home sales, was reading an article today. Canadian home sales in January totals at lowest since 2009. So that was from the Canadian Real Estate Association. So it says Canadian home sales figures in January dropped to their lowest level since 2009, a year when the after effects of the Great Recession were roiling economies around the world. According to the latest data from Korea, national home sales declined 3% month over month in January, while Canadian sales had tiny bumps throughout the final months of 2022. Korea noted this decline effectively erased all of December's gains. To me, I don't think this really says much. However, the last couple of years, January has been a very, very busy month. So, 3% month over month from December isn't surprising, but 9% total does seem like a fairly decent drop from past Januaries, because January's, as I said, the last couple of years has been quite busy.
Yeah, I mean, it is interesting that that it's the slowest since 2009. I mean, obviously that's quite a ways away to go now, and obviously after a huge global impact in the economy. Obviously, this is a direct cause of or effect of all these rate increases and kind of that fear in the market of what are prices going to do, and rates just being unaffordable for a lot of people from a qualifying, or just scared off of what they should do. It'll be interesting to see how this kind of again, like how it continues to ripple. I know we've talked about before, any rate increases takes 3 to 4 months from the last one, like from 3 to 4 months ago, for it to ripple through the economy, and we've had so many successes, ones in succession. So it'll be interesting to see like how these sales figures kind of continue. I know we talked about the last couple of weeks of us personally and in our circles of seeing kind of more purchase agreements and more buyers within Ottawa. I know that obviously Ottawa's, there's more sales within Ottawa that versus some of the other markets like the East Coast and things like that. But it is certainly driven predominantly by the Torontos and Vancouvers. Those obviously affect the numbers more significantly. So I think it's interesting to look at the whole nation as a whole, and what the sales numbers are there. But certainly, again, this being the Ottawa real estate podcast, each market is more localized and it is affected differently. Obviously our sales are down within Ottawa, like from a volume standpoint. This isn't prices being down to 2009 levels. This is just number of transactions. So yeah, over the coming weeks, it'll be interesting to see kind of those figures as they continue to go, because I'm still seeing like tons of pre-approvals coming in, and not tons, like obviously not the same volumes of 2020
but steady,
and 2021, but pretty darn steady for sure. I don't know.
Yeah, I agree. I'm seeing the same thing, and that's why when I see these numbers, I'm kind of surprised, because it does seem like the market is still moving, at least in Ottawa. One of the quotes in the article here, it says early 2023 feels a lot like 2019, where after a year in which it became harder to qualify for a mortgage, everyone was wondering if the market would pick up in the spring. And then obviously we know 2019, 20, 21 kind of things went off. It says in 2019, the market started off slow as there wasn't much to buy. It took off once spring listings started to come out. So it does actually have a graph here showing some of the major cities around. Well, it starts with provinces and then it kind of gets into some of the cities, showing the average price and then the annual price change. I'm just trying to see if this annual price change is just year over year for January. That's the way I'm reading it. But it looks like for all of Ontario, the average price right now is just under 800,000, 798, which is an annual price change of 20, like a negative 20%. That's actually the largest in all of Canada, according to this graph. Some other ones to mention: Barrie and surrounding district, 778 average. That's down 17%. And then Ottawa, average price 603,900. That's down 10.7%. Again, assuming year over year based on these numbers. There are a few places that have gone up. So if you bought in Halifax or Dartmouth, you're doing all right, up 5%. Calgary, still up 6%. And St. John's, so East Coast seems to be the place to be right now, 5.4% in St. John's.
I know we were talking about this over the past few days about kind of those different markets, and it's exactly what I just said. what we were just saying about, these are national numbers, and it certainly matters of where you are localized, because the markets are so significantly different depending on what that industry is driving that. Calgary, the oil industry is doing well and thriving there, and there's a lot of growth. East Coast, people are migrating a lot from some of the bigger cities, from Toronto, from Vancouver, from Ottawa, to these more affordable cities in the East Coast. And so you're seeing that drive there, and other economic factors. I can't speak to, the exact factors in St. John's or Halifax driving that, but it is certainly something where, reading headlines when they're kind of looking at the national scale is going to skew maybe your view, where you're really should be focused on what is going on in your immediate market, and not just kind of relying on that clickbait headline, if you will, to kind of do your research and come to that conclusion, because there is a lot of different factors, and the numbers do really vary between markets.
It does say here too that the national inventory is currently sitting at 4.3 months, which I think I remember you saying that 3 months is kind of is a balanced market. So now we're getting to a point where we got almost 4.5 months of inventory nationally. For sure. Again.
Yeah. I think there's again, I think it'll be interesting to see how this plays out over the next few months from an inventory standpoint, if that continues to go up, if it starts to come down, stays level, whatever it may be. And as the market, depending on, we've got a rate announcement by the Bank of Canada March 8th. So depending on what they do there, how that plays out, and and kind of just going, kind of just seeing like how the market reacts to that, how inventory levels react to that, and I think the next coming couple of months will be telling.
Yeah, you were mentioning Vancouver and Toronto being major players in that, in all basic national statistics. I was reading, I mentioned that, touched on this last week, a Globe and Mail article talking about half of the Vancouver homeowners are mortgage free. And I think that obviously speaks to previous foreign investment. But it does say here that it says Vancouver residents are grappling with the highest real estate prices in Canada, and yet the city has the highest percentage of households without mortgages. So it says half of Vancouver owner households are mortgage free, according to census analysis. And housing in BC and other parts of Canada and story are both abundance and famine. Yeah. So where was it here? Anyways, long story short, the reason why I'm saying this is because I feel like, you obviously have much more leverage if you're mortgage free, as far as being able to continue to, buy homes or even sell homes, knowing that money's all coming back into your pocket. So I just wonder, I'm interested to hear what you think, like how that impacts the Vancouver market. Because I'm sure it's similar. I haven't seen the numbers for Toronto, but I would imagine that it's probably quite similar as far as, homes that are mortgage free.
Yeah, I mean, certainly if somebody's mortgage free, they're able to sit on it longer. They're not being impacted by the rates. They're not going to be rushed to sell it, whether it's investment or owner occupied. I think, again, those sales numbers being down, it's really just from a qualifying perspective, and combine that with, who knows, maybe there's also that foreign buyer ban right now that came in beginning of January, how that is impacting those markets as well, and
that might be a big factor, actually. Yeah.
So those are in Toronto and Vancouver. Those are where I think it's about 5. I think I saw a stat. It's around 5 foreign buyers make up about 5% of the purchases in Canada annually. That's obviously going to be primarily focused in Vancouver and Toronto, I would gather. So you've got that impacting, sales volume decrease. But yeah, those with no mortgage, I mean, they're not impacted the same way, and they'll be able to hold on. I think the numbers would be much worse if there wasn't so many with that were mortgage free. I think the markets would be in a really rough shape if that wasn't the case.
Yeah, it says here Toronto. I read a bit further down. It says Toronto ranked 9th on the list with 43% of households mortgage free.
43%.
Yeah.
Wow, that's pretty wild.
Yeah. Now I wonder how many of we're obviously, our country at least has a large quantity of baby boomers, people that are between, I don't even know what the range would be now, but let's say 55 to 85 years old, 60 to 85 years old. It's going to be interesting to see what happens in the next 15, 20 years when those people do pass away. What's going to happen with, I'm assuming that a large, aside from foreign buyers potentially, but I'm assuming these aren't people working, standard 9 to 5s. They're just paying off their mortgage in 5 years, right? To be mortgage free, you've either been paying it for many years, so kind of fitting into that baby boomer class, or someone who's buying it cash as a foreign investor potentially, or I guess it could be a local investor. But I can't imagine that half of the homeowners in Toronto are just your average mom and pa working their 9 to 5, paying their mortgage off quickly. So it'd be, I obviously they don't have a breakdown of who those mortgage free homes belong to, but I would have to assume that a lot of them are going to be either kind of elderly kind of baby boomers, or people that have bought from other countries. So I'm interested to see what happens in the coming, say, 15, 20 years with that market, when those homes likely are going to either come back on the market or be passed on to family members, or how that will shake things up in those markets.
Yeah, no, agreed. I think another thing that will be something that everyone will want to watch or not necessarily watch, but it'll be interesting to see from a sales volume perspective. And this goes for this is kind of out there for mortgage brokers and for realtors and buyers, really. There's the banks put out a stat that there's 1.1 million mortgages coming up for renewal in 2023. That's a huge number of mortgages that are coming up for maturity, that they are going to have to be renewing at a rate that is likely anywhere from triple to double what they were before. Their mortgage back in 2018, 2019, they were mid threes, really. I know end of 2019, I remember, fixed mortgages, like it was kind of that average of 3.25 to 3.65 kind of thing. And so really from a qualifying perspective, a lot of them are, now going to be, if you're, with a Scotia, where their prices, Scotiabank has some of the highest rates out there right now. So if you are a Scotia client coming up for renewal, certainly shop your rate. Don't just look at renewing with Scotia. They have some of the highest out there. But you're getting in the 5s and potentially with a Scotia, you're in the 6s. But, those are big jumps. And so it'll be interesting to see with those mortgages that are coming up for renewal. Number one, how many are investors and how many are going to be underwater where they no longer want to carry that mortgage and are going to be putting it up for sale, or owner occupied properties where their payments jump and now they're underwater, and kind of how that trickles down to the economy and what their discretionary spending is, how that impacts their unsecured debt and rising, unsecured debt, depleting savings, all that. So it'll be really, some of that will be telling as far as how long also the Bank of Canada holds rates up and kind of that overnight rate being high. But certainly for those, if you're one of those 1.1 million coming up for renewal this year, I implore you to speak to a mortgage broker and look at other banks, what they're offering, shop around. And it might be something where you might have gotten a mortgage, 5 years ago on a 25-year and now you're at 20 years. Well, your payments are going to be based on 20 years on that renewal. Maybe it's worthwhile. If that payment is a shock and not something they're able to manage, maybe look at refinancing. And extending that amortization out to 30 years. That adding that 10 years, yes, it sounds like you're now adding 10 years onto your mortgage, because that is on paper what you're doing, but it's going to bring your payment down dramatically. And you're still going to have the ability to make lump sum payments directly to pay down that mortgage quicker when, cash flow improves or anything like that. So you can, pay down that mortgage quicker, but certainly something, if those payments aren't manageable for you, and you're one of those 1.1 million, like definitely look at those options, look at other banks, have an in-depth conversation with a mortgage professional about your budget, what's affordable and what's out there. I
agree. And on that 30-year too, important to keep in mind that, you mentioned the lump sums. You can, if you're going with a 30-year amortization, that payment that you're locking in is the minimum payment. So being able to prepay that, even if you put, most lenders allow you, anywhere from 15 to 20% as a lump sum even, and even an increase to your monthly payment. So if your payment is, let's say, $2,000, you can increase your payment by 20%, and that's going to decrease your amortization by that same 20%. So if you're taking a 30-year amortization, but you're increasing your payment by that 20%, you're dropping it down to 24 years right off the bat. So you're not technically adding that full, 10 years to your mortgage, but it does allow you, if you're going through, if you have any hardships or, 1 month you need to decrease your payment back down to that 2,000, you can do so. Whereas some people, I see them, they're like, I want to pay my mortgage down as fast as possible. I know you see this too, but and they're like, oh, well, let's go, accelerated biweekly or whatever the fastest payment method is. And I always try to caution them to say you can do that, but you can also just voluntarily increase your payments. If you select the biweekly accelerated on your commitment, on your renewal, or on your mortgage commitment, when you buy the home, then you're committing to that payment for the full 5 years. There's no option to retract it if you've run into financial hardship. If you choose the lowest payment possible and then voluntarily increase your payment, wow, hit my mic there. I don't know if that rang through. If you set the lowest payment and increase your payment voluntarily, then at least you have the option to decrease it again when it comes time. And I met with a friend of mine he's a wealth manager, and he was telling me this year that they had actually priced in 3 rate increases in 2023. That's what they were expecting. He said that, he was kind of explaining that there's 10. I was trying to get him on the show today, but I kind of reached out to him last minute. But basically, he said there's kind of 10 buckets that they look at for whether or not they're going to increase the rates. And one of the, each one of those buckets has different tiers and different things that kind of factor into it. But he said, job creation is a big factor involved. It has a big weighting. And obviously there has been a lot of government jobs created in the last quarter. I think he said to the tune of like 400,000 jobs had been created or something wild like that. And he said what's happening is that, the rates go up, inflation stays up because inflation is being, it's not only the cost of everything, but also the jobs being created. So if jobs are being created, he said it will actually push against inflation. So inflation will stay high because there's still jobs being created and so on. So he said we're just kind of in this cycle right now where it's just spinning in circles. Like we're not actually getting
people can afford those elevated prices of goods, like can still afford those high prices of vehicles and things like that, which drive inflation. I mean, really, at the end of the day, they need the economy to lose jobs in order for inflation to come down.
That's what he's saying, yeah.
And they need, unfortunately, they need people to be suffering and not be able to buy those luxury goods or to be able to buy that vehicle, and they're instead having to repair their car and patch it up instead of just replacing it, because that drives inflation numbers and spending in the economy. But they need, or not be able to buy those certain groceries and things like that. But they need, and we said it, many months ago when I came back from that conference, in that national conference in Vancouver, where they kind of commented that they need blood in the streets. They need people to suffer, and they need jobs lost, and not this addition of 200,000 new jobs and so forth. But it's we're kind of it's in a weird cycle right now. But with that, and there was something, this is kind of a not a great segue, but I do want to touch on, as well as we kind of truck along on the show, is one, something that we're talking about, rates, and something that I've been seeing and hearing rather from some mortgage brokers and some realtors is realtors that are advertising on their listing for their seller that the buyer of that property can assume the mortgage from the seller at their great rate. So for those of you that aren't aware, if you're in a regular mortgage product, and most banks offer this, if you're in one of those low rate restricted products, you do not have this ability. But there's an assumption clause or assumability clause in a lot of mortgages. What this means is that somebody can take over as long as they qualify for that mortgage. So let's say Paul has a $400,000 mortgage. The house is for sale for $500,000. I'm the buyer. I can qualify, and he's got 3 years remaining on his fixed rate at 1.75, and currently rates are in the fives. I can look to qualify to take over his mortgage. If I can qualify for those payments at the old qualifying metrics as well, so easier to qualify, lower payments, lower rate, I can take over, I can buy his house and take over his mortgage. So I can take over that $400,000 mortgage and assume it and all of everything that goes along with it. And then Paul is relieved of that. So what is that doing? It's, it's being used kind of in a marketing tactic, if you will, on that listing, which I think is actually brilliant, for buyers, and it's kind of getting, some added interest in the property. And for the sellers, it's saving them on penalties to break. It would only be 3 months interest, but it's still saving them on penalties to break. And for the buyer, it's, if everything works out for that, on that, they're taking over a mortgage with an absolutely great rate that you're not likely to get again for a number of years, and you're going to pay down a dramatic amount more of a principal. So whether kind of I say this as number one, as a realtor or somebody that's thinking of listing their house, I might be listening. This is something you could think about or get more information on, because it might benefit you in that listing and being creative on that listing from a marketing perspective for you as a seller. Might allow you to, again, move your house quicker, save on a penalty to break that mortgage if you're not looking to port it. Maybe like if you don't have another property that you're looking to move that mortgage to, maybe it's an investment property or something of that nature. And for buyers, something that you can also, maybe they're not advertising, but something you could ask about. And it's something that's little used and known. It's something that, if you're looking at assuming, the time that I've typically facilitated, it's between family members of, a sibling wanting to take it over from another sibling, or, anything like that, or removing a parent off the mortgage, things like that. This is not done through, a mobile mortgage rep or a mortgage broker. You would contact that existing bank's customer service. They'll handle everything. There's a small admin fee. Usually it's in like the $200 to $300 range. They'll provide you with that application for that new borrower. They'll ask for what documents you need, and they go through that internally to qualify that borrower. But it's certainly something that they facilitate that through on the back end. And it can be an insured mortgage, a conventional mortgage. So just something to be kind of aware of what some people are creatively doing out there now.
Lots of options. And that's why it's also important to speak to a mortgage professional, because these are a lot of things that people just, you wouldn't even think to ask that, unless you're told it or you're explained it or you're reading through your contract in detail, you might overlook that. And it could probably help a lot of people currently. Well, something I saw this week too, that I found very interesting. I have a client that has a new build closing in April, and they bought it almost 2 years ago now. And basically what's happened is that they originally purchased it at essentially $1 million a year and a half ago. Now the builder, who I won't mention, is coming out with the exact same model on a fire sale. So now we're getting to the point where their mortgage is about to fund. They have to do the appraisals on new builds are done at 97% completion. So now they're going to basically be ordering an appraisal to have an appraisal done on a property that the same builder has that property listed for, $150,000, $200,000 less than what they paid for it a year and a half ago. So now they're going to be running into this issue where the appraisal may very well come in light, and they're going to have to come up with that difference of the purchase. So I know there's a lot of new builds. I've been getting emails just for, a bunch of builders that are kind of listing new properties around the city. And I think this is probably going to happen a lot. Anyone that bought maybe a year and a half ago for new builds might run into this issue where on closing, the appraisal, when it's done, is coming in less than what they paid for it. So something to be cognizant of, and certainly to discuss with your bank or your mortgage broker as well when it comes time to do that, because that's usually the last step in the process, and you definitely don't want that surprise 2 weeks before closing.
And something as well to be mindful of, to speak with your lawyer and the builder about as well, of what your options are on that property that you might be coming up for closing on. Again, it's something where, kind of not doing anything or not being proactive about it. If you're seeing this happen in an area where maybe you have a purchase agreement signed on a new build and you are seeing other listings, being listed lower, talk to your lawyer, talk to your builder. If something's being listed and sold for that same property from that same builder for less than what you signed that purchase agreement for, and you haven't closed on it, the appraisal cannot come in higher than what's being what's available, or what's being sold on the market at a lower rate. So kind of it becomes irrelevant. And we've said it before about appraisals, like it becomes irrelevant about what you decide to sign a purchase agreement for. It was the same as when people were going no conditions during 2020 to 2022 of no conditions and way over asking. You can sign a purchase agreement for $1 million on a $200,000 townhome. It doesn't mean the bank is going to finance it at $1 million. It's based on what has recently sold. They look at the most recent 3 months sales, and it has to be listed sales. So on the MLS, like MLS listed, publicly, listed sales, and they're looking at that transactional history for the most recent 3 months. And it's within that vicinity of a like property. And so if you are seeing them go for a lot less, be aware of that. Ask, look at that, speak to an appraiser, speak to your lawyer, speak to the builder, and see what your options are going to be of what that property that you purchased is likely to come back at, and make, plan it accordingly well ahead of time, so you're not surprised 20 days before closing.
Yeah. Wild West. We live in the Wild West here. ChatGPT had it right.
Wild East. Wild East.
Wild East. Well, yeah. West of Ottawa for me. All right. Should we sign in the mood boost?
Let's do it.
I don't know how we just talked for 30 minutes, but we did it.
Success.
Yeah. All right. I got 3 today. Number 1, actually, we have a funny comment from one of our friends, Nick, on the mood boost. He said, geez, Paul, when you said those mood boosts, it looks like Dave wanted to kick you off the show. I was like, yeah, it's pretty much every week that happens. So I don't even have Greg to laugh this week. Number 1, how did 2 arsonists hook up? A match on Tinder.
That's a good one. I like that.
Number 2, what did the left eye say to the right eye? Between you and me, something smells.
Okay. 2 for 2 so far. 2 for 2.
Last but not least, number 3, why couldn't Dracula's wife get to sleep? Because of his coffin. Not that cough.
Wow. Okay.
Terrible.
I'm giving it a 3 for 3. I'm giving it a 3 for 3.
Not terrible. Thank you for listening, everyone. You don't have to vote anymore. Faces Awards are closed, but certainly subscribe. We're on our road to 1,000. Head over to YouTube, give us a little sub, and make sure to comment, review, share. We like to answer questions. So if you have any topics that you want us to discuss on the show, certainly slide them into comments on YouTube. You can also listen on any podcast platform, Spotify, Google, etc. And next Tuesday night, we're going to be going live. So 7 p.m. next Tuesday, we're going to be going live. I think it's the 28th of February. So be sure to tune in. You can actually register online on YouTube. The listing is up there, so you can just register and it'll notify you, I think, an hour before we go live. So 7 p.m. next Tuesday, the 28th, we're going to go live. So bring your questions, bring your smiles, bring your scotches, whatever you got.
Yes, sir. Or just subscribe and you'll get notified automatically. That's probably the better way of going about it.
That's true. Tell a friend.
We'll make sure to bring our scotches.
Yes. All right, everyone. Have a good week. See you next week.
Thanks for tuning in, everyone. Bye. We hope you enjoyed today's episode. Please remember to like, share, comment, and subscribe, because we'd really like that.